Hey guys, and welcome back to the channel. Yesterday I showed you the video about the DGOC research from a bear's perspective from Flow, and that was part 1. Today I'm giving you part 2. If you missed part 1, please click on the info screen right now to see part 1, and if you have watched it already, then please continue with me into part 2. So it starts with, if the acquisitions are problematic, what would a hedge fund detective expect a company to do? Acquisitions, circumstantial evidence, but we keep finding it. Yeah, there's nothing new there. I've been seeing DJC acquiring stuff as well. It's like one of the main reasons why I like this business. So I think that the author makes a little bit of a mistake here, but let's have a look. The difference between acquisitions to sustain and maintain versus acquisitions to grow increase. So the author assumes that the acquisitions are made to sustain and maintain their dividends, but we have, or free cash flow, or whatever you want to call it, the acquisitions are actually being acquired to grow and increase, and we have seen that, and every acquisition has been accretive to the free cash flow for shareholders, even though there's share dilution. Could that mean that they're still going to drop? Sure. Is that something to keep an eye on? Obviously. But I feel like the assumption here was a bit off, and while it is an important note, I think we need to focus on the fact that they are in fact increasing with their acquisitions. Something that hasn't been mentioned in the report at all is how these acquisitions have reduced their cost per unit, and this sheet shows that very well. We also know that they have acquired midstream assets, which reduces these costs as well, like on this area. And yeah, it's a bit of a shame to see it like this, because this report was really valuable, is really valuable. I think everybody who wants to invest in DGOC should read it just to have a bear's perspective. However, I don't think it paints a full picture, and it leaves out some important things about these acquisitions that actually tells you why they're different than these MLPs that he mentioned before. And yeah, the fact that they reduce their costs consistently is also something that I truly like about the company. It's one of the best ways to make money in general in life, to reduce your costs, reduce your spending, and for the business it's no difference. Obviously, growth companies do need to spend a lot of money, don't get me wrong on that, but if you are in a mature business and you know what kind of cash flows you can expect, then to reduce your costs with those same cash flows is only going to be beneficial to the business and to shareholders. This is also a picture that we obviously know from my previous videos, and if you see the sheets, then this is something very valuable. The operating cash cost is about 1.17, still reducing, fully loaded, also still reducing. CapEx is something to keep in mind, we'll get to that in a bit. And what I like about this picture is the hedge part. It leaves us with an operating cash margin of 57%. And if you would be unhedged, which we have seen in very low price environments, then it would be 41%. But so even if they didn't hedge and they would reach like this, the company would still have an operational cash margin that's positive. Did he mention anything like that? No. So he didn't focus on the cost at all, he just focused on the business model and compared it to what have previously failed. But this is, in my opinion, very important to include in any research of this business model. Then finally, now we're going to dive into something a little bit more difficult, but I think it's important. I haven't really talked about the well plugging before, and I think this company did a good job in mentioning it. And yeah, I wanted to show you with you the numbers that I've seen and where the risks are, in my opinion. So I'm not entirely agreeing with this research, but I do agree with some of the risks he's seeing. It's worth mentioning that there is another issue around Diversified. They have the liability of plugging this enormous number of wells. I agree. Enormous number, and you'll have to plug them at some point. The company takes the view that the wells could last 50 years or more, and with their auditor published a report on long well life, which is available online. And this is what they mentioned in the report, and it didn't really include much other than this. But if you have a look at this report and their supplement, then there's valuable information there. You should check it out. It's just on the DGOC presentations website, in a part of the presentations at least. And this is something that we get to see. So we get to see the net cash flow that we can expect from the fields, and that is this number from all the wells that they own into the future. That is the expected number. Here they expect the amount of costs that it will be to plug the wells. Yeah. So 1.6 billion in cost for the upcoming 70 years to plug all the wells that they own, and it will generate over that same period 6.1 billion, sorry, in operational cash flow. So capex could go up to 25% over the long term, so that's something to keep in mind. Something that I don't like about this sheet, while it is still correct from an accounting perspective, I feel like it doesn't paint the right picture. So the discounted cash flow, so the present value of the cash flow, is 2.1 billion, while the present value of the costs that are about to, or that need spending, are about 104 million. So you can see the big difference here. And why is that? Because most of these costs that have to occur are very far into the future. And that is something that we see here. Here we see the amount of wells that need to be plugged in the short term, let's say the first 20 years. Yeah, that's under 10,000. And then in the future you have to plug the other 50,000. So let's say about 15% you have to plug in the first, or let's say 10-15% in the first 20 years. And the other 80%, 80-90% you have to plug into the last 50 years. What does this tell us? Well, that this discount that is being applicable or being applied is very, I would say it's a little bit too much into the favor of DGOC. And while this is available on the balance sheet, why is this so favorable? Because the cash flows that occur in this period obviously don't have or are higher than the amount of costs that occur. And yeah, if you do a discounted cash flow method, the earlier you receive the money or your cost, I guess in this case money, the more beneficial it is. And if you can postpone your costs, yeah, the more beneficial it is for you as well from an accounting perspective. So if you look at the cost here, it's like, okay, it's only 5%, but here you see it's about 25%, even more. So I feel like this could be a little bit of a distraction, and not, it is correct, but I don't feel like it represents the entire picture of the costs that are common for DGOC. So that is something to keep in mind. How much this obviously is from a full runoff perspective. So if they don't acquire anything else and they just use whatever assets they have now to use them and produce them and see what happens then. If we look at this chart, and there are a lot of major assumptions here, but I'm just going to go through it with you guys. Here we see that free cash flow, or that cash flow, and we see it run off throughout the 75 years to come, or 70 years, I guess, to be entirely correct in regards to the previous sheet. And again, this might be a little bit too technical, but I hope you guys follow me. What we see in the first 10 years is that they pay off their entire debt, which is not something that is shown in the previous sheet, because obviously this is a cost, but is I guess a balance cost or a cash flow cost, and not a cost in the profit and loss statement. But something I would like to mention, that sure, the debt is paid off if this is a full runoff, yeah, so if they don't acquire anything else, this debt that they have is paid off in the first 10 years. Yeah, that leaves them with a lot of money to spend on other stuff to sustain that 40% dividend yield from their cash flow. So 40% of the free cash flow as dividends. So this is 40% of their cash flow as well to pay that off. But the moment this drops, then they are able to plug and abandon wells for that cost. So the fact that the upcoming 10-20 years does not include so much well plugging is obviously very beneficial to DGOC, but what it also means is that the moment the amount of wells plugging increases substantially, they will have less costs or less money costs, so cash costs, in regards to the debt payments. So that is something that obviously is not mentioned either, and one might argue, well, how beneficial is that? But from a free cash flow perspective and this financial model, that is very beneficial. So in my opinion, very important to look at this. One of the major runoffs is major assumptions, I think, is the full cash runoff, no further growth. So yeah, this is what they have. You can expect this much in dividends if you buy it now for the upcoming 44 years. Yeah, so you're gonna get your money back. It's not gonna be a great investment, but at least for the next 10 years, you'll do better than the market. Obviously, it's a stable commodity price assumption, so they have assumed prices as well. It's like, obviously, it's not going to be exactly like this, but to me, you could just have a look at these and check the sheets. I think these are pretty conservative assumptions. And only thing that is a bit risky is the 4.5% long-term decline rate. The moment the research report from Tom is correct and it's about a 19% decline rate, then obviously this whole model will fail. We haven't seen anything like that in the past 3-4 years since DJC has been operating this business model. I don't think it's that likely that it is going to happen with the way they operate and how focused they are on cost reduction and so on. But if he is correct, then yeah, we are for sure in a bit of a pickle. So based on this report, I decided to ask some questions. I was hoping to get some to use his in-depth knowledge on this industry to learn more as well, because obviously I'm not very knowledgeable on oil and gas in general. Like, I like to learn and read about it, but I'm pretty sure somebody who has researched 70 companies and has built a whole model to simulate results and all that around it probably knows more than me. So I before this I asked a few questions. He replied very shortly, and then I went more in depth with this. And just a few things that I focused on is that I asked him a bit about, or I mentioned that the cost reduction through economies of scale in regards to the acquisitions. I asked him if the decline rates are accurate. How come the results haven't reflected it? I also mentioned a bit about the acquisition that they made and how it was not focused on the decline but more on how it will attribute to the cost in general. I mentioned what was the lowest producing well in your model and how accurate would you presume this to be. Like, I want to know, okay, how accurate has your model been in the past? Have you asked this to any investor relations and see how much it matches with your model? Finally, I asked him, am I correct to assume that you expect more currently run wells to be plugged sooner than anticipated, making the arrow liability on the balance sheet less accurate than one might think reading the asset retirement plans? This in particular refers to the one I mentioned before. Like, the moment the wells need to be plugged sooner, then this liability should be increased. So the moment you think that the wells don't run as long as they are currently thinking it will run, then the cost will become sooner, and then the liability on the balance sheet that has now been discounted with the present value, or towards the present value, would be increasing. So this is the risk that I see. So that's why I asked it to him. And at what point does your model think that plugging well is more cost efficient than having it operate with an extremely low production? Because I think this is important as well. Like, he assumes as well that there is a lot of production costs, or like people going to the well, managing it, maintaining it. And I was just wondering, okay, how much would the cost, or what would be the break-even point for when to plug a well and when to have a well keep producing? And he didn't really reply to any of this, unfortunately. He mentioned the production gains and percent improvements are not consistent with the baseline of their broader portfolio. I would like to see a list of wells where they performed remediation work, not vague slides. Like, alright, if you want to. Also, did you notice that they dumped all their editors at once? It's buried on page 29. I looked at it, I didn't see what he mentioned there. I replied to this as well. Like, I asked him, okay, do you have the model to, or do you have the numbers that prove this, like that they are not consistent? Like, it's your model against the actual financial results of the company. And yeah, I would like to see, okay, in what ways have their production really been declining, because we haven't seen that in their quarterly reports. I asked this question again and he never replied to that one, which is a bit of a shame. I thought we would have some valuable information while having a dialogue with this person, but yeah, he seems to dodge most of my questions. I think they were fair. maybe I went a little bit too deep. Like, I know this stuff can be boring as well, so maybe it was like, well, I wrote this 5 months ago, I'm not going to reply to all these questions. Wouldn't blame him, but yeah, a little bit of a shame. I think I answered most of those questions by looking at the sheets again and yeah, going a little bit deeper than this Tom did, at least in my opinion. So that leaves us with the question, what are my thoughts right now on DGOC? I do believe that my conviction for this company has been enhanced. I believe reading reports of an opposite view of your current investment thesis is always important. If they shatter your investment thesis, you should really be thinking about getting out of that investment. So you probably shouldn't have never entered that investment in the first place if a different perspective trembles your investment thesis. But nonetheless, it could happen. But in this case, I would say my conviction has been enhanced. Yeah, I think I have dug a little deeper, and why it has been enhanced in particular is because, okay, he mentioned that the business model was previously used. I googled it, I looked at the previous companies that did this, and yeah, you see that the mistakes that they made, and well, we see that DGOC is not making those mistakes. They are actually hedging. They are actually acquiring at a decent price and not trying to grow for the sake of growing. They just want to have the cash flow to grow and so all that, and they want everything to be accretive to shareholder returns and so on. So for me, because of that, my conviction of this company has been enhanced. What I also liked about this thesis is that now I understand more why the company is undervalued, because there has been previous business model like this. It is not some unique concept in that regard. It's just that previous business models didn't run it as well as DGOC did. So yeah, it's understandable that the company is undervalued. Investors that have experience in the previous type of investments of this business model probably burned their feet or their hands, and yeah, they're just not confident enough to invest in a company like this. I'm pretty sure the other companies made promises as well. Like I'm pretty sure as well that they didn't show their costs so clearly as DGOC is doing. But regardless, I understand now why this company is undervalued, and yeah, only time will tell if the valuation becomes more in line with what I think because of the certainty that the company offers. But until then, I think it's still a great investment, of course. It's just time will tell. And lastly, simulations without in-depth research paint a picture for consensus. This is just something that I thought of. I thought it would be nice to mention it. If you have a business model and you have any generic type of an research or to look at the business or whatnot, let's say price to earnings, price to book, price to free cash flow, enterprise value to EBITDA, anything, and you can simulate and you can calculate that, and you don't research the company well enough, then you just know what everybody else knows already. In this case, this company uses a very impressive model, I might add, a very impressive model to see what wells are actually producing. And yeah, I showed in the first video, yeah, what you show with your model, you can actually just do that by looking at their quarterly earnings report, because they mention whatever they produce. So do most oil and gas companies, by the way. But by not looking deeper, by not thinking about, okay, what are they doing with the costs? How are they ensuring their revenue? How are they guaranteeing their cash flow? You just don't get the entire picture of a company. And yeah, even though everybody is looking at these kind of companies, like the information is all out there, this is where investors, and especially individual investors like you and me, where we can make a difference by looking deeper, by taking our time, and don't just go with the consensus. Think for yourself and look a little deeper. So that's it for today, guys. Hope you guys enjoyed it. Let me know down in the comments below what you think of this company report of Tom. And what I also would like to know is, did you see the same risk in the liability that I see, or what Tom see as well? Because yeah, I do find that a little bit disturbing. from a balance sheet perspective, but since I'm focused on cash flow, I'm not too worried about it. But yeah, it would be great to hear your opinion on it. Thank you guys for watching, and see you guys tomorrow in a new video.